I covered the new week opening gap for a couple weeks now. My private students have known this. We've talked about this as kind of like a charter level education. And they, as charter members, they're learning equally just like you are. I'm expounding on something that I introduced to them. And now you're seeing the fruits of understanding what that is and what it can bring to you in terms of knowing what price is likely to do next with a great deal of probability. And what is that? I mentioned that the new week opening gap, which is the closing price of Friday, the previous Friday, and the opening price on Sunday, that range, whichever higher, Friday's close or Sunday's opening, and the midpoint, which is consequent encroachment. You want to extend those levels through the entirety of the week. Now, here's another factor. You want to use that same opening range for every week that starts in that same month. The algorithm will refer back to that within the same month. Now, there's a little bit of an overlap too. What happens if you're using, for instance, like we're in the first and second week of February? Are we just using 2? No, you go back as much as 4 weeks because there's going to be rotation that the algorithm is going to refer back to. It's not always looking at the calendar dates like we would look at, like when January closes. Stop right now. This is a reminder because I know some of you are just kicking back, eating potato chips, pork rinds, getting ready for the big game this week, and you're just chilling with ICT. If you're not writing this stuff down, you're wasting your time. You're not going to remember it. You will not remember it. So make sure you have something to write with and record what I'm saying. But you're having basically a rolling 4-week look back. It will, by default, encapsulate a monthly rotation in order flow that the algorithm will refer back to. What I mean by that, the new week opening gap, starting like this week coming here, when we see the opening price on Sunday, we are looking back the last 4 weeks. So there's going to be 4 weeks of new week opening gaps on a chart. You want to save a profile or a workspace or whatever else you would call it on a platform that's outside of TradingView. Whatever that medium is that you save your charts on, you want to set up a template that is for new week opening gaps. And you want to have the last 4. Now, obviously, you'll have a 5th because you're starting with a new week. So right away, you're probably thinking, oh, this is going to be a lot of stuff on my chart. It's actually not. It's actually not at all. So it gives you an X-ray view of how the algorithm will refer back to old areas of real fair value. That's not to diminish fair value gaps, because fair value is an evolving factor and principle in order flow. Now, when I say order flow, I am not referring to some kind of look inside the candlestick. If you're using this kind of chart, you're an idiot because I used to work at Barclays or whatever it is. You've seen that guy on there on YouTube. He's always on my videos now. His ads are running on my stuff. But you don't need to have volume or the number of contracts recorded or shown inside of every individual candle. That's irrelevant. You don't need to know that. That is not necessary. But if you want to subscribe to that and believe that fairy tale that something's going to help you, you're welcome to do that. Go right ahead. But that is absolute bullshit. You don't need anything like that at all. You're looking for levels of premium to discount, time-oriented concepts and entry points and targets, inefficiency in price, and liquidity. Now, you can also create a template for your new day opening gaps. And what is that? That is the difference between the 5 p.m. closing price on the S&P. This is also for Dow futures and NASDAQ futures, and any index really that closes between 5 o'clock and reopens at 6 p.m. Eastern time. So the distinction for new day opening gap, which is always going to be abbreviated as ND, OG, I'm trying to think that I'm saying it right. This is one of those things that you'd never see in the recording. So I'll go back and edit it. I'll hit Control M. I was literally, my fingers were reaching for the Control tab and looking for M, because that gives me a marker on my recordings and I can go back and fix those things. But new day opening gap is the difference between the closing price at 5 p.m. Eastern time, or just simply whatever the local time is in New York. That's why you need to have a clock set to New York time, and your trading view charts should be defaulted to New York time. Everything revolves around New York time. I know it sounds like a typical American thing. Oh, you guys are arrogant. You think everything revolves around you. Well, the fucking markets do. Okay, and that's just the way it is. I'm sorry. If it was revolving around India time, I wouldn't give a fuck. I would just be trading it based on that's what it is. But I'm telling you, that's what it's revolving around. So 5 p.m. closing price and 6 p.m. opening price. That's your new day opening gap, that range. And you want to extend that out. Now, you want to do that for like the week and the week before. That's about as far as, in my opinion, I'm only interested in that. So you're going to have as much as 10 of them on your chart. You don't want anything else on that template, just that. And you will see by having a template like that, and also a template that has the new week opening gaps, where there's nothing else on the chart. Because if you're trying to bring everything to your chart, you're going to look like you're doing what everybody else in retail trading does. They plaster all this stuff. You ever see those people that decorate their lawns for Christmas? When I grew up, we had several homes in the neighborhood that they brought everything out, and you couldn't even see their lawn at all. It was all these like little inflatable things or plastic ornaments that light up and whatever. It was too much stuff. Well, you don't want to clutter your charts up like that. You want to be able to see price in time, and also how it reaches into these areas of real fair value. You'll be surprised to see how markets reach back to them, turn, gravitate back to them, turn, go through them, act as support, go through them, come back and act as resistance. You'll see real order flow. And it's really a fascinating study. And I don't want you to just take my word for it. I want you to look at it, study it. When the weekend, go back and see how the market referred back to those price points. When didn't it respect it? When it didn't respect it, was it on the heels of a market report that was high impact or medium impact? All those things are important for you to journal. So when you're, I guess, screenshotting, or if you're printing, which I think is extremely expensive today anymore, when you're buying ink, it's better just to have in my opinion rather, for keeping screenshots and annotations, it's better to screenshot because it's more economical to do that. But I like, on the weekend, I'll print one chart out, and it's basically what I just shared with you. So what I do is I refer to that, and then I literally pencil in, not pen, pencil in things that I liked seeing about price action. One or two things that I was expecting that didn't pan out, and anywhere that I would have taken a trade that was wrong. If I get stopped out, if I miss a trade, if it doesn't fill my limit order to get into a move, then I'll write down my observations and my thoughts about it. I don't go in and say, shit, I missed this fucking move. Why did I not do that? Ugh, that's frustration. You don't want to record frustration. You want everything. You want to be writing a love letter to yourself. Every single time you're journaling, you're encouraging that inner trader to come forth. You want to manifest that positive thought, principle-oriented, analyst supported speculator. And you want to stomp the shit out of the gambler that's inside of you that wants to well up all the time and push the button just to see what would happen. So you're constantly balancing all that stuff. But I usually print a 1-minute chart like that because I don't need to have a 15-minute chart. I don't need to see a 5-minute chart, because you can see every turning point with that 1-minute chart. But you can also see much more details in the order flow. And I only brought out, in my opinion, some of the salient points, which is also what was making its way into my live streams. So you can see what I was referring to, points of importance to me, and what I felt that was algorithmic for future prognostication, which was told to you real time, either through Twitter or when I was doing the live sessions. So we'll get to that chart in a moment. But for now, I just want to talk a couple principles that you want to have when you go forward, and you've seen me implement them this week in our first, I guess, hands-on over-the-shoulder ICT experience with live streaming and calling the markets.